Welcome to today's training. Today I want to talk a bit about leverage and the benefits of using leverage and how do you calculate leverage. Okay, so let's get started. Okay, so first thing first, what is leverage? Okay, what is leverage? How do you use leverage? So what is leverage? Okay, so basically the easiest way to explain what is leverage, if you can look at my screen, is example. If you were to buy a house, buy a HDB house, you usually don't put up your full payment. You don't fully deposit. You don't fully pay up the price of your HDB flat. Yes or no? Usually you take a loan from HDB or you take a loan from the private sector to buy the house. Okay, let's say example you put up 20%. Okay, 20% of the down payment. Okay, down payment, and so the 80% from HDB or 80% from the bank is your leverage. Okay, so in this case over here, you are, let's say the house is now this HDB not cheap. Let's say example $1 million, right? So you are coming up with 200,000 as your down payment, and then 800,000 comes from the bank or from the HDB. Okay, so this is leverage. This amount that you use up is called leverage. Okay, it's called leverage. Okay, and in the financial terms, okay, in financial terms, what do we usually use? What are the term we usually use? We do use deposit. Okay, what we use is this thing called margin. Okay, we use this thing called margin. How much margin do you need to put up? Okay, how much margin you need to put up as to hold, let's say $1 million stock. How much margin you put up? That is called first the down payment in the property terms, and second thing, right, is the leverage. Okay, so how many times is the leverage? Okay, how many times is leverage? So in our calculation over here, if the house is $1 million, your leverage is so-called 1 out of 5. Okay, so you need to put up 20% leverage. Okay, 20% margin, and then there's a 5 times leverage. Okay, so 20% is your down payment, and then 5 times leverage is basically this divided by this, so it's 5 times leverage. Okay, so same thing is if it's stocks, right? So if it's margin, then let's say example the stock, let's say Apple stocks. Okay, Apple stocks, let's say buy $1 million worth of Apple stocks, and again it allows you to do a 20% margin. Okay, so then you need to put up 200,000 to buy the Apple stock, for 200,000 to put up to hold $1 million worth of Apple shares, and then your leverage is 5 times. Okay, this is quite basic. Okay, so next thing, what is the benefit of leverage and what is the risk of leverage? So let's talk about the benefit of leverage first. Okay, so let's say example right now, Apple shares would go up to, from $1 million, let's say go up to 20%. Okay, got 20% to go to $1.2 million. Okay, go to $1.2 million, it went up by 20%. Okay, so if you calculate the profit over here, will be 1.2 million minus $1 million. Your profit over here will be $1 million. Will be 200,000. So you'll be having 1.2 million minus 1 million, their profit will be 200,000. But if you look at it over here, you don't really need to come out the 200,000. All you need to come out is the margin amount, which is something we talk about over here, 200,000 to hold a position. So your even though your here is 20% profit, okay, they went up 20%, but your net cash on cash, it means how much cash you come out and how much profit you make, cash on cash, is 100%. Okay, this is 100% profit. So that is the benefit of using leverage. Okay, so the next thing, what is the risk? Okay, what is the risk of using leverage? Okay, of course there's benefit, there's also risk. So what is the risk over here when you were to do that? Okay, let's say example right now, the Apple shares, right, instead of going up, it went down 20%. So this time it's minus 20%. Okay, so now it's become 800,000. Okay, so if it's anything below above 800,000, let's say example right now it's 900,000, then it is fine. But once it drop beyond, okay, that means you drop beyond your margin amount. Okay, let's say example, it go to 790,000. Okay, once it drop below 800,000, it dropped to 790,000. Then you have what we call a margin call. Okay, a margin call. So what is a margin call? Basically, to tell you that, hey, your margin, right, over here right now is not enough because your unrealized loss right now is more than 200,000. That's why you need to do a margin call. And then usually there's a short period of time, maybe 1 day or 2 days, which you need to top up your margin. Okay, you need to top up your margin back to so that it's above the margin. Okay, so in this case, you need to top up so that the unrealized loss is higher than the 800,000 over here. So let's say example, you need to top up 10,000 or 20,000 so that it goes back up to hold your position over here. So that is what we call margin call. And in the event that you don't answer your margin call, let's say example, a day or two you don't answer your margin call and then you don't top up the extra money, then what happens is they will be forced sold. Okay, there will be forced selling. Okay, forced selling. And then once there's forced selling, then what happens? It will, let's say, realize the loss. Let's say now round is 790,000. The value is 790,000 and realize the loss of 210,000. So what happened in this case, which is very scary, you will wipe up your entire margin, plus you still owe them $10,000. Oh, that is what is the risk. Okay, so that is the risk of doing this. But later I'll share with you how to avoid or how to prevent this from happening also. Okay, so next thing is who should use this. So usually for all this doing margin and things like that, usually it's more for trading. Okay, when you want to do a short-term position for trading, you want to use margin. Okay, and then second thing, to use margin, which you must be someone that is disciplined. You must know how to use the margin well, that it don't hurt you. Okay, and at the same time, you want to take advantage of the leverage. How can you take advantage of the leverage? Okay, how can you use borrowed money, so-called, to trade? Okay, so that is people you should use it. Okay, so what are the rule of thumb? Okay, what are the risk management rules that you should use to prevent you from having things like margin call or things like being forced sold? Okay, so these are some of the rule of thumb when it comes to trading. Okay, so when it comes to trading, understand that trading is very short term. Okay, unlike buying a house, you can buy for 1 year, 2 years, or holding a position can be 1 or 2 years. Trading can be as short as 5 days. Okay, or even the longer, maybe a month. Okay, but that is not so long. Okay, so that's why you just use it short term to take advantage of the leverage for profit. Okay, so how to calculate the rule of thumb in terms of trading? Okay, in terms of trading, so the context here is trading. You are not investing, you're trading. You got in with an intention to get out. So the key about trading is you need to have what we call a stop loss. You must know what is the ultimate amount that you want to lose if you place a trade. Okay, so today I'm going into details what is trading, about what is profit target, what is stop loss, what is target price, and things like that. But theoretically, there is a way to calculate, okay, what we call the risk reward ratio. Okay, risk reward ratio. And what is a risk reward ratio? Basically is your stop loss, okay, your stop loss and your profit, and then you know your entry price. Entry price is the price you went in. Okay, that means over here is entry price. So stop loss price is, let's say example, you're long, you're buying it, so stop loss will be below here. Okay, let's say example below here, and your profit target price will be above here. So the ratio between here and here, and the ratio between here and here, is what we call a risk reward. This is the risk over here, and this is the reward over here. And generally, you want a risk reward that is more than 1, so that you have a profitable, so you have a better risk reward ratio. Okay, so you want to have when you profit, you make more. When you lose less. That's what we call a risk reward ratio. So coming back again, how do we calculate the optimal amount to trade? Okay, how many when you calculate and prevent you from having a margin call. Okay, so the rule of thumb is like that. We will use this thing called time frame first. Time frame. to look at the market. Okay, so let's example, my time frame is short term. Okay, short term over here, I will define is swing trade. Okay, so short term, I will look at anything 5 days or so. Okay, so anything in 5 days or so, I will risk, my rule of thumb is I will risk 2% of my capital. Okay, 2% of my capital. So later I'll explain what is 2% of capital. And then for long term, for me, I'm doing about maybe 1 month or so, then I will risk no longer than 5% of capital. So next thing is what is capital. Okay, so capital over here is not your capital that you want to the size of your trade. Okay, it's not the size of your trade. But over here, when we talk about capital, is what we call the risk capital. So you risk this amount of capital for trading. Okay, let's say example, you put up, let's say $10,000 in the account. So this $10,000 account, you can use it as a risk capital. Okay, so let's say example, right now you're using 2%. So if you have $10,000 account, then it will be $200. If let's say it's 5%, then it will be $500. So this is your risk that you are taking for each trade. If you are doing on a daily chart and you have $10,000 in the account and this amount is your risk capital, then every trade you would do, you're willing to lose 2% of the capital over here. So from the risk capital, from the amount you risk, you can calculate your trade size. Okay, your size that you trade. Okay, how much are you trading right now in terms of the number of shares? Number of shares. So how do you calculate number of shares based on the risk capital over here? So there's some mathematics over here right now. So let me go through them. So first thing first, just now we talk about entry price, profit, target, and then stop loss also. So from here, we will first put in our here the $200, which is the amount we're willing to risk as the top numerator, and then denominator we'll put in the entry price over here minus the stop loss price over here. Let's say my example, my entry price is $100 and my stop loss price is, let's say, $80. Okay, it should be quite big, huh? Okay, let's say just put $80. So in this case, your risk, your number of shares to buy is minus $20 will be 10 shares. Okay, will be 10 shares. So 10 shares over here, you is the number of shares that you buy, and you are buying at what price? At $100. And if the price were to drop down to $80, which is like 20% down, which is quite a lot, okay? Within 5 days, quite a lot, right? So then you will lose $200. So using this example, let's say example right now, your stop loss is lesser because let's say example it's only a 5 days trade and losing 2%. Let's say your stop loss is, let's say right now $200 same, and your entry price $100. Your stop loss right now is $90. Okay, 10% stop loss within 5 days. You think it dropped 10%, and there will be a stop loss. Then in that case, you will buy 20 shares. So you're allowed to buy bigger shares based on this. Again, 20 shares is based, you multiply that by $100. That's the number, the dollar value of your shares. Okay, so same thing with this example. If you are doing long term, you're doing weekly chart. If you're doing weekly chart, then you change this instead of 2% into 5%. Why is it so? Why is it that when we do longer term, we take higher risks? It's because when you're doing shorter term, you allow the fluctuation, the up and down of the share price to be lesser. You don't expect it to move so much. But when you're trading longer term, let's say over here for 1 month or so, then you expect more volatility. So when there's more volatility, you allow a bigger risk. Okay, and you want to also make more in this case. So coming back again, how about risk reward ratio over here just now. Risk reward ratio over here just now. When we talk about risk, let's say example over here, my entry price is over here right now, and my risk over here is, let's say, $500. Okay, that means if I enter here and then I exit, let's say at a certain price, I lose $500. Then my reward, let's say, is 2:1. Okay, it's 2:1. Let's say my entry price is $100, my stop loss price is, let's say, $80. Okay, and my risk reward means, say, if I make more, I make 2 times. Okay, 1 time, 2 times compared to my entry price is only 1. Then if I'm correct and it go up, then I'll make $1,000. Okay, that means I risk when it go down from here, it goes down, I will lose $500. When it go up, I will make double. Okay, so this make $1,000. That's how you use risk to calculate, or to help you to see whether you have a good risk reward ratio. So at the end of the day, what is trading all about? Trading at the end of the day is about this thing. Okay, it's about 2 things. First thing, when we talk about trading, is about probability. And the second thing we will talk about is the payoff ratio, or the risk reward. Okay, risk reward over here. So what is this about? Okay, first thing first, when we talk about probability, we are talking about probability is, when, let's say, example, under entry price, what is the probability that it will go down first, or what is the probability that it will go down to your stop loss price, or your money that you're willing to lose, okay, or go to your target price or your profit target. Okay, so what is the percentage probability? There must be a probability percentage. Okay, and hopefully you have a strategy that have a higher probability. That means once you enter, the chance of it going to target is higher than the chance of it going to stop loss. That is what we call probability. Then the second thing is what we call the payoff ratio, or the risk reward. So when you are losing money, how much you lose. Okay, and when you're making money, how much you make over here. So it's about managing these 2 things. Okay, and if you have a strategy, what we call a positive expectancy strategy, what happens is then you will be profitable over a long period of time. Let's say, example, right now I have a dice. Okay, I have a dice over here, and the probability of it coming more than 4, 5, 6, which is higher, is 50%, and 1, 2, 3 is 50%. Let's say 4, 5, 6 is 50%. 1, 2, 3 is also 50%. And my payoff ratio, every time I got 4, 5, 6, I make $1. Every time I come on 1, 2, 3, I lose $1. Then in this case, the expectancy is back to 0, because at the end of the day, there is no edge. You throw the dice long enough, you will, after many times, you will just break even. Okay, if you play this game. So, and if you just keep betting on 4, 5, 6, right, and you keep playing the game over a long period of time, you will be you don't make money. Okay, so but let's say, example, the dice is rigged. Okay, the dice is rigged. Let's say, example, the chance of it coming out bigger is 60%, and then the chance of it going down 1, 2, 3 is 40%. Then you have what we call an edge over the market. So this is one way to have an edge over the market. The other way is, in example, even though, let's say, example, right now you have 50%, but if it comes out 3, 4, 5, 6, okay, you get 50, you make $1, and it come 1, 2, you pay 50, you pay the money. Then in this case, you have a better risk reward ratio. Okay, better risk reward ratio, because the chance of it losing is lesser compared to the chance of making money, even though now your probability is only 50%. Okay, so these are example that you can help you to be profitable. Okay, so lastly, how to calculate the how to look at a real life example. Okay, let's look at the market right now, and then we could do a scan. Okay, and we do a scan, and we do a scan over here. Let's say, example, I'll do a short. Let's do a longer term trade. Okay, let's do a weekly chart trade. Okay, and then let's say, example, I do a swing trade. That means I want to trade for a month and look at Nasdaq. This is a scan that's proprietary. We can actually use it to scan, and then I see this stock. Let's say LIND, LIND. And then right now we have what we call a trade setup. Okay, there's a setup over here, And my stop loss, let's say example, I enter over here. I won't go into detail how to calculate the entry and the stop loss, things like that. But let's say example, after I look at the chart, I say, okay, this will be my entry price around 440 would be my entry price. My stop loss price will be below here, 410. Okay, so I reached about $30, and my target price is, let's say, go to 470. Okay, then if I have an example like this, then this will be what we call a trade. Okay, I enter here, my stop loss here, my first target will be here. Okay, so that is what we call a trade setup. Okay, so this is example of a real life example. Okay, so you can go back in history and look at trades. Okay, we don't have time today to go into the how we do the setup, but every trade, okay, whether is it all this list over here, that is what we call a trade setup. Okay, get ready to buy, and then entry price and the target price. Example here, the entry price will be somewhere maybe above here, so maybe $55 and above, and then my stop loss maybe will be here, $52, and my target price will be somewhere here. The first target maybe here. Okay, so again, maybe a 1-to-1 risk reward, but I would maybe do this trade, okay, for a 1 week, 1 month trade. Okay, so this example of a trade setup. Okay, okay, I hope today we have covered a little bit about margin, how you use margin, how it can benefit you, what are the risk factors, and also help you to calculate the risk amount. Remember, your weekly chart is 5%, and then show you some practical example. I hope this video is useful for you. I'll see you in the future videos.